She's one of the most well-known and lately most controversial investment managers in the U.S. Now, Cathie Wood says she's aiming for European investors. Her firm, ARK Invest, is planning new ETFs in Europe in the model of her innovation fund in the U.S., heavy on tech companies and what she calls disruptive technologies such as AI. Well, the innovation fund soared during the pandemic and crashed hard as interest rates climbed. We recently sat down with Ms. Wood and talked about last year's losses, as well as criticism that she isn't managing risk properly. But first, we asked her why she's now coming to Europe. Take a listen.
We're pretty excited to be in Europe because we finally have something to sell here. Practically since the beginning of the firm, 25% of our subscriber base, I mean, we give away our research, but 25% of it is to Europe, Europeans. And the number one question we get, and for the last 5 years, why can't we gain access to your ETFs? And so now, once we go through the regulatory process, this will be a UCITS ETF, or a set of them. We hope to roll out all of our ETFs. We'll start slowly with the flagship ARKK, but we'll be able to offer. And the other thing, the European market is a difficult market, and you need local expertise. You need people who speak the language, who know the customs, know the preferences, and Rise has very similar DNA to us. They're all about global megatrends.
This is the group that you're purchasing ETF.
Yes, the Rise, part of Asset Co, kind of a hidden gem in there that we didn't know anything about. But once we met the founders, we realized, oh my goodness, they're doing research on global megatrends. Sure, they're self-indexed and they rebalance quarterly, and many people are used to that. But active equity ETFs, Europe is opening up for them. We believe that Europe is today where the US was in 2014, 2015 when we started. And back then, we got the question, wait a minute, you can't put an active equity ETF portfolio into this wrapper. And the question was, well, why not? Well, you trade every day. Okay, fine, why not? And sure enough, it's taken off and others are following us. And I think that has given rise to the movement now starting in Europe.
This ETF that you will be offering, you said it's ARKK, basically, which is what your flagship innovation fund is called in the US. Does that mean it will essentially mirror that, or will it be more reflective of European companies or a European flavor for what European investors might want?
It will look very much like ARKK in the United States, at the margin because of rules about concentration, maybe some difference. The last time we looked, not too much difference. So substantially like. Now, one of the things, and I'm seeing it at this conference even, met Frank and talked to him about his portfolios. I think the cost of innovation is collapsing, and primarily because of artificial intelligence. So it's no longer going to be, the preserve of, moneyed areas like the Valley, the Silicon Valley, the other valleys in the world. The costs are collapsing, and we think there's going to be a lot more innovation around the world, including in Europe. So we're thrilled to be making contacts here in Europe, and I can feel the buzz here. People are excited, about innovation in Europe. It's great to see.
You mentioned Frank Thielen. Frank is Frank Thielen. He's an investor here in Germany. He's quite well known here in the country. But I want to ask, who with these products, who are you targeting? Because you talk about obviously wanting to stay away from a passive. This is not a passive fund that's tied to an index that mimics an index. Do you feel like there's a risk appetite here in Europe where a lot of people would look at it and say, this isn't a place that tends to take a lot of risk with investment, not a place where there's a whole lot of retail investing in general compared to the US?
Yes, well, I think through the intermediaries you have the retail investor through the major banks, and we have to convince them, but Rise is convinced that the time is right. You know, they've had great success with their own funds, and so they have a client base that has an appetite for innovation to begin with. So that's a really good start for us. And you know, our strategies, like all innovation strategies, are volatile, and so they shouldn't be a huge percentage of any equity allocation, perhaps, certainly not in the beginning. We just need to get a toehold in, and now is a really good time because the last, 21 and 22 were terrible years for long duration strategies, including innovation, including long bond funds. And that's because of skyrocketing interest rates. We've never seen a 22-fold increase in interest rates in the span of little more than a year before. We're done with that. Now, maybe there's one more. I would be surprised. I think we're seeing a hard landing evolve around the world, China, Europe, US, and I think the Fed will change its spots, and that will be an ideal environment for long duration strategies, including ours.
So more pressure to lower interest rates after this incredible period of raising interest rates.
Yeah, and one of the reasons is money growth is negative on a year-over-year basis. M2 is negative and has been since the beginning of the year. That hasn't happened since the 1930s. That is telling us something. The leading indicators, I think, are down 15 or 16 consecutive months. We've never escaped a recession in the US after that long of a decline in leading indicators. And this idea of a soft landing, that's what everyone says when we're heading towards a recession, and it's usually wrong.
At the same time, we do see pressure, for example, oil prices continuing to go up. Can we be sure that interest rates are really going to start coming back down, especially here in Europe, where there are some other factors really playing into things?
Sure. If you look at in the 2008-9 period, right before that, from the end of 2006 into 2008, oil prices went from $60 to $147. And we were on the threshold. So what was happening was that became a tax, a cruel and regressive tax on the consumer. And that's what it is this time around as well.
I want to ask you, you mentioned 2021, 2022, a brutal period also for your funds, for your flagship funds. You've reaped a lot of criticism because of that massive fall. Your fund had a massive ascent and then an equally brutal fall. The criticism, of course, that someone who got in from the beginning of that ride up was worse off after everything came down. How do you respond to that criticism about your role in that and what you should have done?
Well, what we do is research, deep research into innovation. And if anything, our conviction on the 5 innovation platforms around which we've centered our research and investing, so robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing in the life science space, if anything, our conviction has increased that these are going to deliver exponential growth trajectories. We've had a horrible period. Actually, it is the opposite of what happened during the tech and telecom bubble, right? We had a bust, and it was worse than the tech and telecom bust. That should not have been. The technologies are ready today and the costs are low enough. We are in prime time, or getting ready for prime time for these 5 major platforms. And not only that, they're converging. Autonomous taxi platforms, robotics, autonomous vehicles are robots, energy storage, they will be electric, artificial intelligence, they'll be powered by AI. Those are 3 S-curves, each of them alone are S-curves, and they're going to be feeding each other. So I think averaging in, staying the course, if you believe our research. If you don't believe our research, don't bother. You know, I'm serious about that, because if it doesn't interest you enough to read it, if you're not fascinated by how your lives are going to change, then you probably don't want to invest, and you won't have the right constitution in terms of holding or averaging down. So I average down in my personal portfolio We average down into our highest conviction names when we're going through a bear market. We did that and we shrunk the portfolio from 58 names to 27, but averaged down. And I believe in the next year or so, those averages, we might have averaged all the way down, but we will beat those average prices on the way up.
The criticism, of course, was that as those interest rates were rising and rising and rising, and everyone else was moving to protection, that you had an almost contrarian glee to staying in your positions too long. Have you reflected on that, or is that something, what do you say to that, that kind of criticism?
So it's not what we do. We do one thing. We invest in disruptive innovation, and we think it's going to be so big, and that the growth rates associated with these companies so great that interest rates shouldn't matter. If you talk to a good value investor, and we have a value investor in our strategies, an institution, who has made that point exactly. They said, you know, these algorithms which decided that rising rates meant sell ARKK, that was kind of mindless. If you look at what the growth rates that we have to offer going out into the future, now you have to give us a time horizon and look at our research to see the depth and see or make a judgment call whether we're right or not. Those growth rates are going to be so phenomenal that 5% interest rate shouldn't make a difference.
But I guess it was the concern that comes out of this is this idea that you had a blind spot for downside risk in that moment to protect investors' money. When everyone else was moving in a certain direction, you doubled down in many ways on what you were doing. And that meant that your investors ultimately suffered. In the end, they came out in worse shape despite having gone through this amazing peak.
So we do one thing. We invest in disruptive innovation. And our risk mitigation strategy in that narrow context, that's all we do. Advisors have to choose how much are they going to put it. It's their choice, not ours. We do not raise cash. We have zero cash, ever. We do this, that's all we do. And an advisor has to choose how much they want to allocate. Our risk mitigation is saying, okay, our confidence in these 27 names is much higher than these other 28 names. That's what we do during a bear market. But we only do what we do, and that's invest in disruptive innovation. We're not an asset allocator. Lots of other people out there are asset allocators. Advisors are asset allocators. They could have chosen to sell our names, and some did and some didn't, you know, but they know their clients' risk tolerance, and they know whether they have put too much or too little into our strategy, meaning if they only had a toehold, 0.5% of a portfolio, and they just kept averaging down, my guess is over the long term, averaging down just to keep that 0.5, my guess is they will be very happy over the long term.
But you would see that sequence of events in 2021, 2022 as a kind of anomaly then, I would say. That's the way that you would look at it.
Quite anomalous, and the opposite of what happened after the tech and telecom bubble and bust. So during the bubble, you know, what was happening? Momentum chasing, right? This was late 90s. And it was wrong. If you had been doing the research back then, technologies weren't ready, costs were too high. The same research today says the technologies are ready and the costs are low enough for scaling to take place. That's where we are. And, you know, you can't take that away from us because, you know, we've been right on electric vehicles. We've been right on Bitcoin and other crypto assets. And what we're finding in this quarterly earnings call is while everyone gets hit, if there's any cyclical exposure during a downturn, and we've seen tech in a downturn. I'm talking about fundamentally companies becoming very cautious, cutting back and so forth. So everybody gets hit, but what you see, and we saw this in this earnings cycle, our companies are gaining share. So Roku, for example, in the streaming TV space, it's a platform on which Netflix and Disney and HBO sit. Its advertising is now up double digits, while linear TV advertising is negative. So we're beginning to earn our way back after fears of cyclicals taking us, much lower are abating now.
You mentioned crypto. You're big on Bitcoin, Ethereum. You are asking the SEC for a Bitcoin spot ETF. That introduces all sorts of new volatility as well. Is that in itself not even more, I guess, cyclical in a way when we look at how Bitcoin has soared and then crashed, soared, crash, soared, crash? Is that not a dangerous bet?
Well, if you look at the 3, 4, and 5-year rolling averages of returns for Bitcoin, they've outperformed stocks, bonds, everything. So the trend is up, but hugely volatile, as you say, hugely. And what is interesting about this is young people especially are used to it. They just believe in it. And they're used to this volatility, and they're learning how to use that volatility to their own advantage. Those are the people who are very attracted to our strategies, because similar volatility, more than I would have ever expected, but then again, I never expected the Fed to do what it did. But they're used to it, and they're keeping their eye on the prize. They're saying, I think this research is going to be right, and I think ARK has, because of the way it does its research, has found the right companies. The companies that will help investors stay on the right side of change, and that will help people stay on the right side of change. This is the way the world is going, not the way it has gone, which is represented by the broad benchmarks.
You've become something of a brand yourself for your investment portfolios. Is that a double-edged sword? How do you look at it? You're so well known, everyone watches every move that you make. I would imagine that has a great benefit, but does it ever get in the way of the decisions that you make? Does it threaten to get in that way? You have sort of a mantra of always being bullish on technologies.
Well, so I'm going to go back in time. I joined my last company right in June of 2001, right in the middle of the tech and telecom bust. And I was at a company which was benchmark sensitive. Technology was, I think, at 36% of the benchmark at the time. And I inherited portfolios with 40% tech. I took them down to 11%. Technologies weren't ready, and the costs were not low enough. Too much capital had chased too few opportunities too soon. The seeds for everything that we're experiencing now in terms of technology revolution were planted during the 20 years that ended in the tech and telecom bubble. We didn't have the cloud until 2006. We didn't have the first really big breakthrough in AI until deep learning and ImageNet in 2012. We didn't have the more profound breakthrough, transformer architecture, until 2018. And when it came to sequencing technology, it cost $2.7 billion to sequence the first whole human genome in 2003. That was after the tech and telecom bubble. And only today is it cheap enough. We're now down to $200 to $400. Think about that. In the last 20 years, we've gone from $2.7 billion to sequence your genome down to $200 to $400. The odds are very high that you are going to get your genome sequenced every year, every other year. You'll have a geneticist, and as you age, that geneticist will tell you all about the mutations that are evolving in your body. Mutations are programming errors. And then we're going to have CRISPR, gene editing, which will edit out those programming errors. So, I don't think people could have dreamt about that in tech and telecom bubble. We are ready for prime time now. It is curing disease, beta thalassemia, sickle cell disease, ATTR, and CRISPR Therapeutics is now working with Vertex, is working on diabetes. that will be the category killer for gene editing if they're able to pull that off. And they've pulled it off in 3 rare diseases.
All right, Cathie Wood, ARK Invest, thank you so much for your time. We
My
appreciate
pleasure.
it.